Do you know the problem with keeping all your eggs in one basket? One slip, and they all come crashing down. And the same applies for where you keep your money. But don't worry, Insignis Cash lets you spread your savings across leading banks, maximizing security, flexibility, and returns. No more sleepless nights, no more smashed eggs. So get cash clever with Insignis. Visit insigniscash.com now to learn more and get started today. That URL again is insigniscash.com.
Hello and welcome to Fintech Insider Insights. I'm David Barton-Grimley, Fintech Strategy Director right here at 11FS. And on today's episode, in association with Insignis Cash, we're discussing funding. Funding stories are everywhere. We've probably covered over 100 on Fintech Insider News in 2024 alone, to be honest. Everything from seed rounds all the way through to IPOs, and there's a few big ones coming up on the horizon. But what actually goes into making these funding rounds happen? And maybe more importantly, what happens after the money actually hits your account? So let's find out, shall we? To discuss, I'm joined by a great panel of industry experts. And first off, we have a warm welcome to my 11FS colleague, the one and only Jamie Campbell, head of VC at 11FS. How are you doing, Jamie?
Yeah, I'm doing very well, thank you. How are you?
Awesome. Yeah, I'm good in this surprisingly toasty podcasting room. It's kind of amazing. And next up, we have a Fintech Insider debut for Giles Hutson, CEO and co-founder of Insignis Cash. Giles, welcome to the podcast. Tell us a little bit about yourself and why you started Insignis Cash.
David, thank you. It's great to be here. Effectively, we set up Insignis Cash to solve access to the UK banking system. So there's a lot of companies, complex client types who would like to use multiple bank accounts to manage risk, to increase return, but the complexity and workload of managing those multiple bank accounts, particularly if you are a relatively small treasury team, which tends to be the case in younger companies, makes it very difficult. So we provide effectively a one-stop shop for access to 47 banks within the UK for our client base.
Fascinating. Yeah, welcome to the pod. And next up, we have another Fintech Insider debut for Kirsty Lowe, Finance Director at Perlego. Welcome to the show, Kirsty. Please tell our listeners a little bit about yourself, Perlego, and what you do there.
Hey there. Well, thanks for having me. My background is I've kind of only worked startups, scale-ups, I guess, over the years, probably done pretty much every role within a finance function. And prior to joining Perlego, was doing that as a portfolio FD, with my last client actually being Perlego, who I joined last summer. So we're often billed as Spotify for textbooks, and it's effectively a subscription-based access to a digital library. We run two sides of the business, both D2C and B2B. So we cover everything from giving students direct access through to actually working with kind of universities and institutions themselves to sort of partner on that broader impact. And my role here is, very varied, everything from kind of scaling the finance function, learning treasury from scratch. We are one of Insignis's clients, and as Giles alluded to, we do not have a treasury team. We have my spare time, through to we recently just closed a fundraise. So kind of quite in the loop of sort of currently living the what's next.
Awesome. Congratulations on the fundraise. And I've got to say, I really could have done with Perlego when I was in university because the amount of textbooks that I had to lug around was incredible. I'm sure lots of our listeners can relate to that. All right, cool. So we've got our panel. Let's kick off the show. So to start off with, we'll be looking at the current funding landscape and how to raise money. But right at the beginning, Jamie, let's come to you first. Can you explain to our audience what is a fundraising round and how does it work? Why do we even call it rounds, like we're playing some kind of game?
Yeah, well, a round is a sort of shorthand for various different things. From a founder perspective, you are an owner of your business. You want to raise some capital, but you also want to give away as little of your business as possible as you grow. And so, you have these kind of staged rounds where you raise a little bit of money early on when your company is at a lower value, and you raise larger amounts as you kind of go up these rounds. And from an investor perspective, you want to put your money at risk in a measured way. You don't want to put hundreds of millions of pounds into high risk, into one single high risk business. You want to probably spread that risk across multiple different bets, especially if they're early stage businesses. And so a round really is, we have an alphabet system to make it very easy for everyone, except for the earliest rounds. Typically, you would get a seed round at your youngest phase. Over the last 5 years, pre-seed rounds are becoming more and more common, and you have specific investors who focus really on these kind of pre-seed and seed round areas. It's interesting to note then at this stage, you're a very early stage business. You probably don't have much in the way of data or in the way of traction on your product or your project. And so investors at this stage are going predominantly off of the vision, and people are fundraising off of the story of the vision that they have. So typically the founders at this stage require a certain level of expertise, a certain level of insider knowledge as to what's going on in this particular sector, which gives them some kind of unfair advantage against the competition, or at least gives them credibility as to why their concept is worthy of fundraising. And then you move up the alphabet, A round, B round, C round, D round, and it goes on and on and on. And typically, as you go up those rounds, the amount of money you are raising increases. And as such, the risk that an investor is willing to take is going to have to be lower. And so at that, when you get into an A round, for instance, there needs to be some level of certainty or some level of traction, which shows that if I put 30 million pounds into this business at this stage, then it's going to lead to certain commercial outcomes. You're probably unlikely to be at profitability at this stage, or you're probably unlikely to be at profitability by the time your A round funding runs out. And so, that money has to come in with a relatively high degree of confidence that, if I put money in now, we're going to be able to show enough traction so that when you go out and get more funding in your B round, then we'll have the right pieces on the plate to go around and do a roadshow. And so really it's a game of working up these stages as a founder, and then as an investor, making sure that you're managing risk across your portfolio of businesses effectively.
Amazing. Thanks so much for that, Jamie. And then I guess into the overall exit, whatever that exit eventually ends up by looking and Giles, I guess, and then people come to a business such as yourselves to go and put all of that raised cash and then do something with it. I mean, I'd love to get your views on the kind of market conditions generally for fundraising, with the startups that you work with. What have you noticed?
So I think overall we've seen a rebound in 2024. You mentioned earlier on, you discussed many financings. We've seen certainly a couple of difficult years. And we certainly noticed in the second half of 2024 a material pickup in activity. That's the first piece of the jigsaw. I think there's greater confidence within the investment community around the ultimate monetization of that investment, whether that's improvements in the terms for stock market listings or greater activity in trade finance. Ultimately, one of the many things that an investor will think about is, how do I get my money back? If you are a venture capitalist or a private equity firm, you're not standing there just with your own money, but your own limited liability partners you're answerable to. You have a certain chronology around when they need a return on their investment, and therefore you're trying to match the chronologies of your investors with the ambitions and the liquidity events associated with the companies you invest in. And the key to matching those chronologies is the ability to get the takeout. So if the takeout market is healthy, you have greater confidence going in, whether that's a couple of years earlier, 5 years earlier, whatever the time frame happens to be.
Fascinating. And so that's very good news. I mean, it'd be worth also reflecting on the fintech industry. So I was just reading a stat here that says that early stage deals, so that's the seed and Series A, say pre-profitability, as Jamie was saying, account for something like 81% of all deals globally, which seems to indicate that there's now like a newer wave of people founding businesses. Jamie, are you seeing a similar rebound in the fintech industry as well?
Yeah, I think in fintech, you know, generally you get these waves based on events. You know, whether it's a technological event, whether it's a regulatory event, a political event, a financial crisis event, which inspires entrepreneurs and inventors and creators to take a technology, you know, take a change in regulation and do something with it, adapt to that market and see what can be commercialized as a result of it. And you know, this year, last year, you know, a big rise in AI-focused businesses who are taking a larger who are putting AI as a larger piece of their roadmap and raising funds as a result of the improvements it can make to their business. You know, we're seeing a lot of that. I also think the other side to this is that it's more difficult to raise larger rounds. You know, the bar for the types of traction that you need to be demonstrating at these later stages is increasing, you know, which is leading to, you know, slightly larger or inflated figures on acquisitions. You know, we've seen in the UK a number of acquisitions, you know, and you know, in the role that I'm doing here at 11FS, I'm seeing a lot of businesses looking to be acquired or to have conversations with potential acquirers, rather than going for, you know, another round of funding to get them to that next level.
So in some ways, an easier exit by saying, let's just get acquired, and maybe we can have shares in the new co, and then grow in a more sustainable way. That's very, yeah.
Yeah, and Giles is right. Those different pressures that you can get, those different chronologies, you know, whether it's the LPs or whether it's the founders, you know, who all have a plan, you know, whether it's written down or whether it's something that's just floating around and, you know, between their ears. Everyone's got a kind of timeline that they want to be working towards, and you know, you could take the call that now is the right time, rather than, you know, twisting and going again, you know, for you know, and then potentially having an exit in 3 years. You know, so all of these competing things are kind of driving those different decisions.
Really interesting. And Kirsty, I'd love to come to you as, you know, a company that's just finished a successful raise. I mean, what are the options still available to founders? Would you say that VC is still very much the kind of traditional route forward that most businesses do, or are you seeing anything else crop up?
I mean, I think it really depends kind of on both the business model and stage as to probably what's going to be the most appropriate option for them. From the ones I've worked with in Perlego in particular, kind of VC did open sort of certain doors and certain round sizes to us, but that's also, there's a lot of options on the table at the moment. And I think, you know, I've worked with businesses where actually, you know, revenue-based financing, where you've got those more predictable cash flows, is a really strong option nowadays. And obviously, there's upsides and downsides to the current interest climate, but actually, you know, the debt financing is also kind of a key lever for certain businesses, and particularly where we've got kind of strategic projects that we can link that to. It's been an option on the table. So I think you've kind of got a lot more things to sort of levers to pull than just kind of going the traditional route. But I certainly think the traditional route does open up kind of larger round sizes to most businesses.
Definitely still here to stay, right? And Giles, just on the VC angle, are you seeing any shift in their strategies over the past year or so as the market kind of rebounds?
Well, I think with a slight smile, there's a recovery element to this. Yeah, valuations have been rebased. If you think about fintech, the majority of fintech globally, not just in the UK, is debt related. You know, buy now, pay later is effectively lending by any other name, and debt-related services in the context of a rising interest rate environment that's a tough place to be. So I think we come out the other side of that now. So I think that sort of recalibration is very, very important, and the sort of efficacy of new capital into the market. So that's why I think we're seeing this rebound in the second half. I think while rates may stay higher for longer, I think they are currently, there's a sort of sense of predictability around which people can make a plan. And therefore, we're seeing a little more cash put to work. I would say that some of the terms associated with that are sometimes quite stringent. So it's not just the amount of money or the valuation. It's also quite a lot of devil in the detail in terms of some of the legal and protection parameters that go with that. So I think the legal process is arguably more complex than the actual financing process. Finding money, in inverted commas, is one thing. Finding money with that you can match both from a chronology and a legal perspective is where the rubber meets the road.
So getting much stricter on risk management after having been burnt quite a lot, I guess, over the last few years.
Absolutely, there's a swing on which you're involved in any industry. In the insurance industry, if you just had a big loss, you tend to up the rates on that particular asset class. In any investment organization, if you've had a tough time in a particular area, you're going to do your best to protect yourself from it happening again. So it's not a criticism. I think it's just a natural rebalancing, if you like, of that protection paradigm. But I think the industry needs to think a little bit about whether that's applicable to all clients or whether that's applicable to clients where the risk profile is genuinely higher because they're either earlier stage or the amount of money involved is more material, to Jamie's point.
What do you think, Jamie? Bring you in on this.
Yeah, I think the strategies that I don't know if I have anything to add, to be honest. I think the strategies that I'm kind of hearing about are very much people are rebalancing and recovering. I think I can definitely sympathize with what Giles is saying around finding money where the legal structure around it is incredibly is incredibly limiting to founders, or it imposes certain restrictions on founders that probably haven't been considered previously. And I think that is especially if you are in a debt raising mode or your business uses some sort of function of debt, the covenants that are attached are now probably a little bit more restrictive and a little bit more aggressive on the from the lender's side. But that's natural. That you would kind of expect that, given the situation that we're in, given the rate, the interest rates, given given the kind of the consumer market and what that's the performance of the consumer market, you'd kind of expect that.
And given how big, lending is in fintech, particularly in the kind of embedded area, which is just inherently more risky. Kirsty, we've been talking about various different strategies for raising, but I'd love to get your view on how the pitching process actually works. How do you pull together a pitch? Particularly, I suppose as pre-seed business, you've got a couple of founders who have an idea and they pull a pitch together and get the money. But it's very interesting for a business that's in flight, right? You're raising Series A, Series B. Founders have got to run a business at the same time as try to figure out how to raise all the money. How does that work?
With difficulty, I would say, if you're being honest. I mean, I think going back to kind of the point Jamie was making around sort of as you progress through the rounds, there's a certain expectation that comes with that in terms of what's being looked for and the underlying that supports the vision. So at the end of the day, kind of pitching is a lot about storytelling to begin with and actually kind of bringing people along the vision. My role often comes into the process a lot more about getting people to really then buy into it and having the evidence to back that up once you've kind of got the initial hook. So I think that pitch process is one that kind of, to be successful, works really kind of in tandem between sort of the external facing and also making sure we kind of have the internal diligence and supporter models to actually back that up, that once you've kind of got people bought into that big picture, that they have the opportunity to dig into the details and really understand how we're positioned for that longer term growth. Because at the end of the day, sort of even with a rebound, that market now is still being a little more stringent in trying to understand, what am I getting for my return? And we all talk of a path to profitability, but what does that look like in reality when I start to dig through the numbers?
Yeah, you've got to be prepared for the fact that there's several analysts will be tearing through all of your projections and coming back to you with
yes,
my
model was ripped to shreds by a selection of analysts.
Oh boy, do I know how that feels.
And it's, it's a, I've been on both sides of it, and it's interesting to, see the differences when you're criticizing assumptions. When you are in the driving seat, when you are the optimist, when you are the founder, and the world is all opportunity ahead of you, and the tricks that it can play with your brain to kind of sprinkle a not such a small amount of hopium on top of the numbers, whereas when you're at it from the other side and you're really on, you're looking for all of the assumptions that are going to, be the downfall of these businesses. Where are the groundings of all of these different assumptions, or what's the rationale behind all of these things? And your job really is to poke and prod at everything, and it typically is the model that gets the most poking and prodding, unfortunately for the finance people. But really, it's in those assumptions that the business becomes visible. How does this thing make money? At what cost? And how much will it cost us to get to a point where this business breaks even and goes on to earn, profits, and ultimately could lead to a successful exit? And if it's not in the model, then it's unlikely to be a successful conversation. And I think it's worth as well talking about the time that this all takes, because when you're a seed investor, I mean, I was I'd come off the back of a successful startup, had a successful co-founder. We raised our first pre-seed in 2 weeks because we knew the right people. We had a deck that was compelling. We had some unfair advantages, knowing certain things about the market that other people probably didn't know, particularly around applying technology to a particular problem. But, I've been on the other side where raising that next round takes 6 months. The general rule is that it always takes 3 times as long as you think. So if you think it's going to take 6 months, it's probably going to take longer.
Kirsty, how long did yours take?
Oof, I think I built that model a year ago, and we closed over the summer, so about 9 months.
Wow. Gosh. And you got to run a business in parallel. I mean, that's extraordinary.
I would say that the fundraising task is incredibly time consuming. And so if you are a founder listening to this, my recommendation is to have someone in the business who you can trust to deputize your operational accountability to, because you're going to be taken everywhere. And I would say if you are someone who is operationally senior and has a good grip over a lot of things, I would say you should be waving your hands around. If your boss is going around and doing some fundraising, you should be trying as hard as you can to lighten the load on that individual, because it's not only is it time consuming, it is very very damaging to it can be very damaging to your mental well-being as well. So any help you can give will be definitely appreciated.
I think there can be a silver lining. The only silver lining I would think about here, having been through this twice, is you effectively get free consultancy. You're quite right. You are absolutely a glass half full individual. That's why you set it up in the first place. That's everything you believe. You see opportunities coming at you from every possible direction. And then someone else's job is to poke holes in that. And that's not meant to be lighthearted. That's a good thing. That's okay. That's their perspective. And sometimes they're right. And sometimes there's a reality check or a level of discipline that you then apply to your business that can be helpful for your long-term growth. So I kind of see it. Yes, it is absolutely exhausting. It is absolutely, time-consuming versus the growth of the business at its core. But you got some significant takeaways at the qualitative end as well as the cash you end up with.
And that's where that other wonderful startup word comes in: pivot. You can pivot through the process and keep pivoting until you get that profitability. And on that note, we're going to take a quick pause here for a quick break. after which we'll be discussing what to do with the money once you've fundraised. Where does it go? What do we do with it? It's all coming up after this super quick break, so don't go anywhere.
Cybersecurity is the top concern for UK businesses, according to Vanta's recent State of Trust report. But whether you're a startup founder or an experienced security professional, Vanta is here to help. Businesses use Vanta to establish trust by automating compliance needs across over 35 frameworks like ISO 27001 and SOC 2, centralize security workflows, complete security questionnaires up to 5 times faster, and proactively manage vendor risk. Join over 9,000 global companies like Flow Health, Synthesia, and Alica Bank who use Vanta to manage risk and prove security in real time. For a limited time, get $1,000 off Vanta at vanta.com/insider. That's VANTA.com/insider for $1,000 off.
This episode is brought to you by Indeed. We're driven by the search for better, but when it comes to hiring, the best way to search for a candidate isn't to search at all. Don't search, match with Indeed. Use Indeed for scheduling, screening, and messaging so you can connect with candidates faster. Listeners of this show will get a $75 sponsored job credit to get your jobs more visibility at Indeed.com/SBO. Terms and conditions apply.
Welcome back to Fintech Insider Insights, where we're discussing the current landscape of funding. Before the break, we discussed how fundraising works and what the current trends look like across the ecosystem. So now we'll be discussing what to do after a successful fundraising campaign. So, Giles, let's come to you first. You've just raised the money in one of the many ways we discussed in the first half. What do you do next? How do you spend it?
So I think in your, as Kirsty will attest to, in your model that you built in advance of the fundraising, there will be a cash flow element to that. There'll be a use of proceeds plan, and there'll be a chronology to the spending of that use of proceeds. So I think one of the things that we're seeing a lot of clients do, and I don't think you can have this conversation without using the 3 words Silicon Valley and bank in the same sentence. I think a lot of clients do is actually get their ducks in a row as to regards the use of the proceeds before the proceeds hit the current account. And by use of, I mean not having all in one bank, and obviously ideally maximizing the interest income associated with that deposit, as well as reducing the risk. So we actually work with a number of venture capitalists, and they will actually send us the pre-signed documentation so that we can open up the account to get everything lined up and ready to go. So when the funding comes in, it actually may even come directly from the lawyer's account. It may come from the current account of the company that's raised the funds, but it goes straight through into a multi-bank environment and starts earning interest from day one. And actually, not many people have factored in the interest income into their financial model in the first place. So it's a nice kicker, if you like, to the assumptions that you've made in the financial model. Obviously, this was hugely turbocharged in the spring of 23, when pretty much every CEO in the UK woke up and said, where the hell is our cash? Why is it all in one bank? Why is it not spread out, et cetera, et cetera?
So UOPs are primarily a post-SVB kind of consequence.
I think it's really increased significantly. Yeah, I think that's a fair point, a fair question. A lot of people, it probably wasn't nearly as much on the radar. And then a lot of people didn't sleep for a week at that critical point in time. A lot of people have then discussed the horror stories associated with it, and it's become more mainstream since then.
I think as well, spreading that, spreading your cash across a number of FSCS protected accounts is not only useful from a risk perspective, but also, there's changes to the cap on, fraud clawback from your bank. So there are multiple reasons as to why spreading this risk is kind of becoming more and more important. It kind of goes back to my point earlier around you see a lot of innovation growing when there are changes, either regulatory, from a law perspective. I think this is one of them, or when something goes bad, from a financial risk perspective. And I think this is a great example of an industry that is growing in popularity as a result of a shock.
Yeah. And fraud is increasing massively. I mean, it topped £600 million in the UK last year in this particular sector. So it's really not great. So spreading that risk is very, very important. I find so fascinating, Giles, what you're talking about, the interest that it's not calculated in the actual fundraising, because in the current climate, that could actually amount to a significant amount of money. And I just wonder whether it's something that VCs might be using to say, like, well, if you can sweat more of this money by getting it in a high interest rate, and therefore utilizing it just a hell of a lot better. And on that thread, Kirsty, I'd like to come to you about some of the macroeconomic factors when considering this, because I think it's so fascinating that you mentioned your model is built over a 9-month period, right? And during that time, not only are things changing within the business, you're pivoting, you're getting feedback, it's getting ripped to shreds and all that kind of stuff, but things are also happening in the economy, right? The cost of employment might be changing. You might be getting tax rises or decreases, or you're assuming that you're hiring someone in one country, for example, and actually you need to hire them in another country. There's all sorts of things that kind of come at you from various different directions to actually spend this money. What's some of the stuff you've seen?
Well, I think you've touched on a fair few factors. And I'd actually say kind of part of how we managed this was exactly as Giles said, I did not include the interest income in our cash flow and effectively used it as a buffer, which allowed a little more flexibility as and when there kind of were changes. But kind of, I'd probably say there's about 4 or so kind of core ones we saw over that. One being the general rising cost of employment. I think particularly kind of off the back of the recent budget announcement.
Yeah.
Obviously, it's the changes to national insurance and the kind of onus on the employer side. Whilst it's great that it didn't fall on employees, making the kind of overall cost of employing people has sort of led to the questions as well around whether it actually makes sense to have full-time versus whether we look at contractors more to offer that flexibility. And I think probably the other kind of core one that came out of the budget for us is actually the changes to the business asset disposal relief. Obviously, a lot of startups our size use equity as an incentive and as a lever to kind of offset perhaps salaries which don't match what you might be able to get in an open market. And so sort of the knock-on impact of the increases there are obviously quite significant for anyone who is bought into that as a lever and a route moving forwards. And I think the kind of other 2 ones sort of we've probably seen the most is we're a global business. So obviously currency fluctuations, and we saw a lot of that, particularly between USD and GBP over the summer, can have quite a knock-on impact. So you're sort of managing not only whether you have revenue streams and cost bases in different currencies, but also just even if your reporting is in a different one and sort of the impact it can have from that not aligning to your kind of core revenue currency as well. So I'd say they were probably kind of a few of the sort of more macro factors that we've seen.
So fascinating. And when you're pre-profit as well, you're so tightly geared. A business that is profitable and growing has all sorts of options for how it can manage its cash flow. But when you're Series A or seed, these kind of differences can make a huge difference. But Giles, let's just assume that, this startup, any given startup has, lots of money in the bank. They're not spending all of it immediately. What do they do with it? And this, by the way, was one of the biggest problems with the SVB collapse, is that you had these very high, maybe not dormant, but certainly passive balances in singular bank accounts. Is it just a question of saying, we're going to have an account that we use for our transactions, and we're going to have an account that we use for our savings? Does it work something like that, or is it more complex?
So I think there's probably 2 angles to this. Number one, it depends on the amount of money. So to Jamie's point about FSCS protection, companies in the UK generally do benefit from FSCS eligibility. So anything up to £1 to £2 million, you can actually create lots of £85,000 buckets and reduce the risk on the counterparty with the bank quite significantly. Obviously, if you have much larger amounts of money, FSCS plays a smaller part in risk management. So we have a lot of clients who say to us, I've got 20 million sterling, and can you just place it in 6 single A banks? That's using the credit rating as the risk parameter as opposed to FSCS. So it's partly correlated to that. I think the other piece that some people often forget is the current account piece. is that it's not just about if your bank goes bust. It's also about, do you have access to the funds from an operational perspective? And so you need to make sure there is a pipe or more than one pipe back to the ability to do payroll, for example. So we have had one company come to us a little while ago where their current account provider had a tech event. And so we were able to route money back directly from a savings account back to a hub account and then back to payroll. It's not something we'd love to do on a day-to-day basis, but it does at least provide that insurance policy. So it's partly about bank risk and people thinking about Silicon Valley Bank getting into trouble. The banks don't go bust that often, but it's not just that risk. There may be operating risk or cyber risk associated with getting the money back in time to pay the bills.
Gosh, it's so complex, isn't it? Jamie, let's imagine, all right, this company, it's got its money, it's spending its money, it's raised Series A, it's hitting revenue, it's hitting profitability. Obviously, exit is on top of everybody's mind at some point. When do we think that a founder and the investors are beginning to really seriously think about the exit strategy? When does that come in? Is it all the way at the beginning?
I think a lot of, not all, but I think a lot of founders start their journey thinking about some sort of life-changing amount of money that can happen at the end of it. It's not always the case, obviously, but I'm sure, especially in fintech, I think it can you can get both sides of the of the equation. Some people who think big number at the end, other people who think about maybe closer aligned to some sort of financial inclusion goal, maybe a smaller number but a bigger impact in terms of social mobility. But certainly investors are thinking about money out. And as soon as you take an investor, it's going to be one of your targets. It's going to be one of the things that you are driving towards, because that's what motivates the investor. That's where they're not getting involved on a purely interest basis. The fact that they like your project, they think that it can be commercially successful as well, typically. And those exits can come in at all different at all different stages. I mean, I think I was reading recently that Atlantic Money exited a deal very recently, and they've raised hardly any money. But for the right price and the right, whatever it is, an earn out on the other side, or, the right makeup of a deal, then, large companies can acquire, can create the environment for an exit if they see real value in this project and they want to get it cheap. Then they'll try and go as early as possible. Or, the recommendation would be to try and go as early as possible before they realize extreme commercial value and start telling you it's worth £1 billion. But equally, I think once you get to, I think there's a certain, there's, whether it's written or an unwritten rule, there is certainly a greater risk when you start getting to the larger rounds where profitability is seeming more and more difficult to reach because of some sort of fundamental error in the modeling. Typically it is the cost of acquiring customers. That's not always the case. Sometimes it's the cost of servicing clients, and that can drive a number of that can kick off a number of conversations internally, which can inspire an early exit as well, where maybe something doesn't seem like it's going to be, the big successful thing on its own, and needs something else to prop it up, or needs something else to make it more effective. It needs a smoother way of acquiring customers into its machine for it to work. That was what I experienced at my previous company. On its own, it had a really neat financial engineering aspect to it, but when it was paired with its origination partner, it became much more interesting and much more commercially successful. And so all those different things can kind of become a larger part of the conversation, which drives this kind of the direction towards exit. Ultimately, if you're a successful business scaling very, very well, increasing profitability, all you have to do is look at the regular names that we usually talk about, and really there are two exit opportunities. You either get bought by someone else, or you go and do an IPO. And an IPO requires a certain number of commercial aspects to be hit. You have to be a profitable business. You have to be you generally need a certain level of governance set up in your business so that you can actually be a credible listing on the LSE. If you're going LSE or if you're going NASDAQ, you need to have certain processes in place to make that realistic. But certainly, there are many drivers that can start that conversation around when do we exit and for how much.
And some of those, names that are big and upcoming in the IPO areas, you look at things like Revolut and, Monzo and Klarna and all of those big ones. I think what all of you have been saying is that the process overall from seed all the way through to exit is taking a lot longer perhaps than it used to. And in some ways it's a lot more 3D. It's a lot more multifaceted how you do that. I mean, it might actually be worth talking about secondary share sales because, where the IPO is taking a long time, some of these much bigger businesses are actually stepping in and saying, actually, no, there's a lot of early stage employees or founders here who would quite like some money, quite like some liquidity. We're not quite ready to IPO yet, and let's just go and raise all those hundreds of millions for those employees and early investors. Giles, do you know much about what happens there with secondary share sales? Does that have an impact on the sort of the cash assets that the company is holding? How does all that work?
So not so much on the net cash balance of the company itself, because let's say they raised 10 million sterling for sake of argument. Most of that money will then get paid to the as you said, some of the early minorities or some of the early stage investors that want to take some liquidity off the table. So from our perspective, they then become a client as an individual who's benefiting from that cash flow, as opposed to the cash staying on the company's balance sheet. I think there's a lot of good work being done in the UK around this space. We're following very closely what the London Stock Exchange is doing with Pisces, for example, and that conceptually is very interesting to us. I appreciate it's early stage, but the ability to have a recognized exchange stroke platform where you can raise secondary financing to provide a level of liquidity to your staff or to your early stage investors is something we would see as very, very compelling, and potentially providing sort of more macroeconomically a bit of a bridge for companies to not have that binary outcome. I've either got to have totally illiquid stock or I got to sell the whole thing, which we think and hope then provides UK Inc., UK Limited with greater flexibility and potentially make some of our companies last longer, get bigger, become national champions, because that's a slice of the capital journey that hasn't really existed in the UK as much as it has in some other geographies.
Right. And is it the case that in the US, the secondary market is more common and normal? Because this is something, I don't have any stats to hand, but this is something that I've heard of anecdotally over the last sort of decade or so, trying to make these, secondary markets or private markets less opaque and more accessible for retail investors. Is that like a general trend globally that the UK is behind, or is it still very early days?
I think I'd best answer that question in scale terms. I think the US private equity and venture capital industry is so much larger that it provides greater flexibility to take chips off the table, even if the company is at a meaningful size. That's probably it's a size related piece rather than an overall concept related piece. There are plenty of secondary offerings in the UK.
Right.
They tend to, again, be recycled back into a similar investment community. And so what I like about the concept of something like Pisces is that if you can build an exchange-based platform, and then you can over time align that with some of the pension fund assets, for example, that have been obviously very high profile as being earmarked for private capital, then you've got something very exciting to fill that middle slice of a company's capital growth, and potentially end up with a more stock exchange-based takeout environment than a trade sale-based environment, because you can provide secondary liquidity in the meantime.
Got it. And that might take then the pressure off having to go to IPO as an exit event. And it could just elongate even further the process of fundraising, and maybe even prevent it in some cases. You can say, actually, no, we don't need a full IPO, maybe, if there's another way to do it.
Yeah, and you marry the Pisces project with some of the evolution of the listing requirements on both AIM and the main exchange. You can see, I think what the London Stock Exchange is doing is trying to build what I would very crudely call a middle slice of capital. This country in the UK is great at very early stage stuff. We've got a very supportive tax regime. It's a very productive market. The statistics show the UK does really, really well in the early stages. We don't have necessarily the depth of private capital balance sheet to take a lot of our companies all the way through to being the next Google or the next Apple. And I think some of these projects are, potentially quite exciting steps to address that.
Critical for UK PLC. And listen, thanks to all of you. That wraps up today's fascinating discussion. I've certainly learned a lot today. Thank you so much for joining me. Where can people find out more about you all? Jamie?
You can just find me on LinkedIn, Jamie Campbell, 11FS. Just hit me up there.
Giles?
So I'm on LinkedIn and also on the Insignis Cash website, although the photo is deeply unflattering.
I'm going to go check out that photo now. And Kirsty?
Ditto. You can find me on LinkedIn.
And me also, surprisingly, on LinkedIn at David Barton-Grimley. Thanks for listening, everyone. If you like what you've heard, follow our podcast and don't forget to leave us a review. It helps us to make it better and helps others find the show. As always, if you want to join the conversation, find us on social media. Just search for 11FS or Fintech Insider or email podcasts@11fs.com. Thanks very much and goodbye.
Cybersecurity is the top concern for UK businesses, according to Vanta's recent State of Trust report. But whether you're a startup founder or an experienced security professional, Vanta is here to help. Businesses use Vanta to establish trust by automating compliance needs across over 35 frameworks like ISO 27001 and SOC 2, centralize security workflows, complete security questionnaires up to 5 times faster, and proactively manage vendor risk. Join over 9,000 global companies like Flow Health, Synthesia, and Alica Bank who use Vanta to manage risk and prove security in real time. For a limited time, get $1,000 off Vanta at vanta.com/insider. That's VANTA.com/insider for $1,000 off.